All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan. Today we're going to look at a bunch of the indicators everyone is calling for the end of times and why I'm going to play devil's advocate and disagree with most of them.
I love it. If you guys enjoy this sort of entertaining stock market content, please consider giving us a like and subscribe below.
Two Stupid Guys Trade Stocks.
All right.
Let's get into it. So, are you familiar with the death cross, Vinny?
I have heard of it.
It's crap.
The golden cross, that must be great.
It's also crap. So some people do use these. I've seen these in comments of other YouTube videos. I got most of these indicators from other YouTube videos that were calling crashes because everyone's like, it's in a crash. There's awful. They've been saying this since like 2018. But death cross, super simple. It's when the short-term 50-day SMA crosses below the 200. So when it's going down and crosses it, and then that's the death cross. Golden cross is the exact opposite. So it means sell when it's going down below it, buy when it's going above it. Right? Seems simple.
Yeah, it seems like it would be a lagging indicator too. Like it'd be after you would have wanted to get out.
That's the problem.
Yeah.
So let's just look at gold. Okay. So here with the arrows are 8 death crosses, and in 5 out of the 8 cases actually marked a better short-term buying opportunity than in 4 cases for long-term buying. So it's actually had less than 50% success rate, which statistically very bad.
Yeah.
Especially for a lagging indicator.
Mm-hmm.
I know what you're thinking, Vinny. This is gold.
Yeah.
Who cares?
Yeah. Gold follows its own rules.
And that is valid. That is fair. So screw that. How about all stocks ever?
I love it. Oh, God.
So we're going to play a game here, Vinny. You can see I blocked out the left and the right one. We don't know which one is the gold, which one is the was a death cross. Sorry. So what this is from 1998 to 2018. This is 1 month after the event happened, meaning either the golden cross or the death cross. 6 months, 1 year, same thing. Okay. What are you noticing with these values? Like 11, 12, 5, 6. Ooh, this one, information technology. This one was better.
Yeah, one is usually consistently a little bit worse, I would say.
And what's weird is like this one's actually higher in all 3 categories. This one's higher in all 3 categories. So this has like 4 wins. This has like 5 wins.
Yeah.
Then we go to the unassigned stocks, and 1 year after the event had negative 35% return, negative 24% return. That's not great. That's pretty bad. So let's go to more modern times. A lot of stuff has changed in the stock market. Okay. Now we're seeing very, very similar numbers across. Like this one wins in all 3 categories. This one won in all 3 categories. This one's better. This one's better. This one's worse. This one's better. This one's better. Yada, yada. Right?
Yeah. It'd be hard pressed to say that's anything but a random statistical anomaly.
Yeah, because they're very close. This is slightly better in some of them, or like a little bit over half of them. This is the death cross. This is the golden cross.
Perfect.
So 1 month, 6 month, 1 year out. It's useless. It doesn't do anything.
I love it.
This is from insightfactset.com. I then was like, all right, this is crazy. I want to look at some specific stocks. I did not cherry pick stocks. I picked like Apple first. Huge mistake. The 50 like never touched the 200. It just never gave me an opportunity.
Yeah. Apple
most of the tech stocks after like 2012 just like they just didn't touch. So I picked Costco. All these arrows are the events happening and it immediately failing, and that happens every single time that it actually touched. This had a 0% success rate. So going up, you would have bought here, or I'm sorry, it would have told you to sold, and nothing happened, and then your buy also came back down to where it was. It's coming down. They're saying, hey, let's sell here, right? This is a death cross. Well, it never really gets back to this price ever again. It just keeps on going up. Let's sell here again. Same thing, just straight up. It's not a good indicator. Schwab, whole different sector.
Yeah.
Same crap. It's saying, hey, we're going down. Sorry, the blue is the 50, the green is the 200. I thought that was obvious, but it's saying sell right here. That's literally at the bottom. Then you miss out on this like 6-8 month worth of gains. And then it's saying, well, why don't you sell right here then? Well, you all of this. That's like 5 years, 4 years. It's not a good indicator.
Beautiful.
Oh boy.
Good indicator. Oh boy. You're ragging on my boy here.
Now, granted, I'm playing devil's advocate just to offer a new perspective.
Yeah.
Because,
oh, God.
You know, Buffett, he knows what he's doing. So, can you explain the Buffett indicator?
So the Buffett indicator kind of looks at whole market, kind of market cap compared to GDP, basically considering like how much the value the investments have compared to the economy as like a whole is what this is looking for.
Okay. All right. I don't think it's that great.
I love it.
So it is what he just said. It's like stock market capitalization over the GDP times 100. I'm just going to give an example. Buffett started buying Apple in 2016, right? I got a NASDAQ article from 2019. We analyzed the usefulness of the Buffett indicator on individual stock. So using Buffett's own rules, Apple 2019. I chose this year because he bought a bunch of it. 1 trillion market cap, 250 billion sales. That's 388% on his own indicator. But he's buying. I know you're thinking, hey, this is not for stocks.
Yeah,
it's for the whole market.
This is the whole market. Yeah.
All right, fine. Who cares? There is an assumption that American companies acquire all their revenue in the U.S., which was true when he made the indicator. That makes perfect sense. Now, because of global commerce, it's not the same thing. Apple, AMD, all these people sell all over the world, so that GDP is not being properly factored in because it's domestic product, not global product.
Yeah, it's not designed to be an end-all be-all. It's just designed to tell you, like, in general, is there more or less likely to be good deals available on the market right now?
Yeah, I mean, it's definitely better than the death cross. So,
yeah, it makes more sense, I guess.
I'm going to say most people don't think RSI is a good indicator, but I saw a weird amount of YouTube comments saying use RSI. I don't know. That's a very short-term thing. Here's the SPY over. This is a long term. This is 6 years. Do you want to count how many up and downs there were here? I don't.
If that was your EKG, you're probably gonna die in the next 5 minutes. I'll tell you that much.
Like, I don't even. This is insane. The amount of false positives and negatives in here are like this one worked. Yeah. This one actually no, because it wasn't oversold when that happened. That actually didn't work either. This is a nightmare. I don't know.
Yeah.
All right. Here's another one. What's this, Vinny?
So the Schiller P ratio is an inflation-adjusted P ratio designed to kind of give you an idea of what the stocks are kind of trading in terms of relative to their earnings of the companies within the S&P 500 index. And that's a little scary when you see that we're at the tip of a little spike there.
It is, and I agree with you. Okay, let me pull something up. I agree with you. Why am I? Oh, I have too many screens. I'm getting confused. Sorry. So, basically, your Black Tuesday, it wasn't a great day.
No.
Black Monday, which in no way was this high. This was actually, it was kind of low compared to where it's been when other peaks have happened.
15 is kind of considered to be the average PE ratio. It was pretty much in line with that.
Pretty much in line. So now you're thinking, well, whoa, 1995, this is real high right here. Because remember, if you're looking at this 1995, you can't see all this. So let's sell, Vinny.
Oh, yeah, I know, right?
It's cool. And then we'll miss out on like 3 years of the greatest gains that time has ever seen.
Yeah, exactly.
And then you're saying, hey, it was up here. I'm just going to wait because it's too high. Its correction was above where you even quit because you're looking at a lagging indicator graph.
Yeah.
So it's like you just miss out on all this. Come on.
Yeah, that's the problem with trying to time the market is that as easy it is to call right now that the market is exuberant, it could continue to get more and more exuberant and you can miss out on all those additional gains, which would offset at least a portion of, or even potentially all of your losses when it corrects back towards the normal base.
Exactly. Coming up 2016 about here, this looks pretty high. This is at the Black Tuesday level.
Mm-hmm.
You would have missed out on all of this had you been looking at that graph.
I know, right?
The great thing is I found an article from 2014. It took me forever trying to see what people were thinking around here. And one analyst goes on CNBC and is like, yeah, this is crap. This could keep on going and just go on forever. Like, we don't know. And then he got a lot of crap for it. And I'm sure he holds that article in his pocket all the time.
I hope he does.
He should.
Yeah, he should.
Declining credit happens before a crash. So we're all in trouble. What do you think about the auto mortgage credit delinquency theory here?
Yeah, I mean, it's an interesting thought. I mean, obviously, people are getting overextended and have assumed too much debt. They've levered up their personal lives too much. If you start to look at that sort of thing, we're going to probably see a little bit of a mortgage delinquency, foreclosure spike here now that the moratorium is ending at the end of this month. But
true, and that actually makes one of these data points completely useless because there was no mortgage delinquencies because of so. Yeah. But just looking at what was going on, here's the mortgage. Actually, since 2008, we're actually killing it. We're doing very good. We had that spike here, but ever since then, we're actually at quite a low level. So not bad at all.
Yeah.
Auto delinquency by 90 days or more. This is courtesy of ycharts.com, but this goes back to 2008. You look at these numbers, and honestly, they're almost statistically, it's just a write-off. They're too close. We had some low ones here. We had some high ones, 12, but there's some great returns that year. So I don't know. Yeah. I don't think there's any correlation there.
No.
This one was very interesting, and I'm sure you saw about the credit card debt during COVID actually went down.
Yeah, significantly.
A lot.
Yeah.
Yeah, they said a lot, and then I looked at this graph. I'm like, holy crap. People really learned how to be financially responsible during COVID.
Yeah, learned or just had too much cash and made some somewhat wise decisions.
Yeah, either way, good for everyone who lowered the credit. This is another one showing, I don't know, people are saying stock buybacks play a big part, and the more stock buybacks, the closer we are to a crash. I couldn't find a graph that was longer than this.
Okay.
But this is also super dependent on policies, during Trump's policies that favor stock buybacks. So we had way more here. And once again, you just missed out on 3 years of gains if you listen to this.
Yeah.
No bueno.
What percentage of these buybacks is Apple?
Yeah, I know, right? That's actually pretty funny. What do you think about this one?
Like I said, market can be irrational and can continue being more and more irrational. That's no indicator of timing.
I forgot the official name for this. It's irrational exuberance, when stuff just stops making sense, right?
Yeah, I forget what that quote's from. Is that Alan Greenspan or something like that? I think
it's something.
Yeah.
I can't play devil's advocate for this one. So the EV bubble makes absolutely no sense. Tech is kind of overvalued, and crypto makes absolutely no sense.
Yeah.
So this is logical. This one makes sense.
Yeah, that great quote about when the market can remain irrational longer than you can remain solvent. That. I know you hate that I say that quote so often, but it's completely true.
It makes sense. It absolutely makes sense, and that's why there's so many people calling for a crash. I'm hedging myself just to be safe, but I don't think it's going to happen for a bit, just because so many people think it's going to happen. I think it's
That's true. That's the other lovely Buffett line about be fearful when others are greedy and greedy when others are fearful. So people right now are fearful. So it's still a time to be greedy, per se, if you were to just follow that one simple mantra.
Exactly. And the only indicator that I think matters is volume price analysis. That's what I do. That's when you're looking at the actual SPY or Q chart and you say, hey, there's a big bullish bar on the SPY, but not that much volume. That's an anomaly. That's a problem. That makes sense. That also is tried and tested. Like, you just have to work at it because there's, it's kind of more of an art thing, but it works.
The only thing I think matters is discounted free cash flow.
Yeah, no, then that works too. Fair enough. I didn't put that in here.
Yeah. All right, guys. Well, thanks for tuning in. Let us know what you think in the comments below.
Have a good one.